How do major companies navigate incredibly complex changes, from redefining their core business and ensuring financial health to tackling really significant legal challenges?
Yeah.
It's not just about managing day-to-day operations, is it? It's more like a high-stakes game of strategic reinvention. Welcome to the Deep Dive, your shortcut to being truly well-informed. Today, we're plunging into the recent financial results and strategic moves of DuPont de Nemours, Inc. We've sifted through their latest Form 10Q and a recent press release. Our mission here is to unpack the most important insights, help you understand DuPont's current standing, its ambitious plans for the future, and, well, the significant challenges it's actively managing. So for you, we've got a lot of compelling information to dig into.
Okay, this is where it gets truly interesting. One of the biggest headlines from DuPont isn't just about their numbers. It's their bold strategic move to separate their electronics business. What's the core of this transformation?
That's right. It's a big one. DuPont announced back on January 15th, 2025, a target date, November 1, 2025. That's for the completion of this intended separation.
And this will create a new, independent, publicly traded company called Quantity Electronics, Inc.
Coinity Electronics.
Yeah, it's a fundamental reshaping of DuPont's identity, really.
And what's particularly noteworthy, I thought, is that this spinoff won't actually require a shareholder vote.
Correct. No shareholder vote needed.
But of course, it's still subject to all the, customary conditions you'd expect for a move this big.
Oh, absolutely. Things like board approval, crucial tax opinions, SEC filings,
Right.
various regulatory approvals, and of course, securing the appropriate financing. It's a massive undertaking.
Sounds like it.
It absolutely is. And this planned separation, it's already triggered a significant internal shift. They call it the 2025 segment realignment. That was effective in Q1 2025.
Okay.
So they've essentially created two new distinct segments internally already. The first is ElectronicsCo. That bundles together their semiconductor technologies and interconnect solutions businesses. Plus, some electronics-related product lines from what was industrial solutions, think high-performance materials like their Colres sealants, critical stuff for electronics manufacturing.
Got it. Colres. And the second one?
The second segment is IndustrialsCo. Now, this comprises the former water and protection segment,
Right.
all their healthcare and non-electronics businesses, from what used to be industrial solutions like Vespel parts and
Wow.
shapes.
Yes, advanced polymers.
Exactly, for demanding industrial applications. It also includes their auto adhesives and fluids, multi-base, and Tedlar businesses. Those were previously under corporate and other. So it's a pretty comprehensive restructuring, designed to really sharpen their focus on key markets.
Okay, so this planned spinoff, it's a huge strategic bet. And, for any big corporate move, the foundational question is always, is the company financially healthy enough to pull it off? And are the core businesses performing? So how do these latest numbers reflect DuPont's financial standing as they embark on this? Let's dive into the core numbers for the second quarter and first half of 2025.
Sure. Okay, looking at the top line, net sales. For Q2 2025, they increased by 3% to $3.3 billion. And for the first 6 months of the year, they were up 4% to $6.3 billion.
Okay, decent growth.
Yeah, but what's truly insightful here, I think, is how they got that growth. While sales are up, it's driven almost entirely by volume. A 4% volume increase in Q2 and 5% in the first half. Currency also gave them a little boost, a 1% favorable impact in Q2. Pricing, however, that saw a 2% decrease in Q2 and 1% in the first half.
Less pricing power then.
It suggests that, yeah. For you, the listener, this probably means strong demand for DuPont's products, but maybe less ability to raise prices in the current market. Now, moving to profitability, operating EBITDA. That's a key measure of core operational earnings. It increased a solid 8% in Q2, reaching $859 million.
It's pretty good.
And it was up 11% in the first half to $1.65 billion, so operationally strong.
Okay, that is a strong profitability picture, but I noticed something interesting in the report. A significant difference between their GAAP income and the adjusted EPS. Can you unpack that for Q2? GAAP income from continuing operations actually increased 35% to $238 million. But for the first 6 months, the company reported a GAAP loss of $310 million.
Right.
Yet, adjusted EPS rose 15% in Q2 to $9.12. Why the big difference? Why is it important to understand that distinction, especially with that large GAAP loss?
That is a crucial question and important for our listeners. So, GAAP, generally accepted accounting principles, that income is the strict official number. It includes all charges, including non-cash ones like that significant goodwill impairment we should probably get into.
Okay.
Adjusted EPS, however, often excludes those one-time or, non-operational items. So it provides, arguably, a clearer picture of the company's underlying business performance day to day.
I see.
So that GAAP loss in the first half of 2025 is largely due to a big non-cash goodwill impairment charge they took. It doesn't really reflect the ongoing operational health in the same way.
Got it. And focusing on cash flow. Cash provided by operating activities from continuing operations was $381 million in Q2. That's actually down 28% from the prior year. What's behind that decrease?
Yeah, that's noticeable. And for the first 6 months, that cash flow decrease was even more pronounced. It dropped from just over $1 billion, $1,020 million in 2024, down to $763 million in 2025. This was largely attributed to a few things. Increased cash used by net working capital.
Okay. Money tied up in inventory and receivables.
Exactly. Also, shifts in variable compensation payments and, importantly, significant transaction costs directly related to this intended electronics separation.
Ah, the spin-off costs.
Right. Those are hitting the cash flow now. However, if we look at their transaction-adjusted free cash flow for Q2 2025, it was $433 million, which is actually a 2% increase.
Okay.
So this adjusted measure, it gives us maybe a clearer picture of their more normalized operational cash generation once you factor out those one-time separation costs that are part of this whole transformation.
Right. Makes sense. Now, let's zoom in on the performance of these newly realigned segments, ElectronicsCo and IndustrialsCo. Where is that growth truly happening, and maybe where is it not? What's the story in each?
Certainly. Let's start with ElectronicsCo. Net sales increased by a robust 6% in Q2, reaching $1.17 billion. And an impressive 10% in the first half, hitting $2.29 billion.
Wow, strong growth there.
Very strong. And this was primarily driven by volume increases 8% in Q2 and 12% in H1. Growth in semiconductor technologies specifically was fueled by strong ongoing end market demand, especially from advanced nodes and AI technology applications. That's a big driver.
AI again.
Yep. And their interconnect solutions business also saw robust demand from AI-driven technology ramps, content gains, and even share gains in areas like advanced packaging, thermal management, laminates, metallization, hot areas.
Okay.
So this strong performance translated directly to a significant jump in operating EBITDA for ElectronicsCo, of 14% in Q2 and 20% in H1, reaching $373 million and $746 million respectively.
And that's even with strategic growth investment.
Exactly, even while investing for future growth. So this is clearly a growth engine for DuPont right now.
Definitely sounds like it. What about IndustrialsCo?
Okay, now for IndustrialsCo, net sales increased a more modest 1% in Q2 to $2.09 billion. And it was 1% in the first half as well, to $4.04 billion.
So flatter.
Yeah, relatively flat. Here, a 2% volume increase was partially offset by that 1% price decrease we mentioned earlier. Within this segment, though, there are different stories. Healthcare and water technologies showed high single-digit organic growth.
Oh, okay. That's strong.
Driven by things like medical packaging, biopharma, reverse osmosis membranes. And remember that acquisition of Donatel Plastics, the medical device company, back in July 2024?
Yes.
That's now part of this segment too, adding to that growth.
Right.
However, the other part, diversified industrials, that experienced low single-digit organic sales declines.
Oh, okay.
It was mainly due to softness in construction and automotive end markets. We're seeing that elsewhere too.
True.
But despite this mixed picture within IndustrialsCo, operating EBITDA still rose 3% in Q2 to $509 million and 4% in H1 to $973 million, boosted by that volume growth and productivity efforts, although partially offset by the pricing pressure.
So still contributing positively overall, just not the same rocket ship as ElectronicsCo.
Precisely. It's a mixed picture, but still adding to the bottom line.
Okay, so we've covered the ambitious strategic shifts with the spinoff, the financial performance underpinning it, and the significant growth in key areas like ElectronicsCo. But, it's not all smooth sailing. DuPont is navigating some pretty significant charges and ongoing legal challenges. These really stand out in their recent filings. Where are the biggest headwinds right now?
Indeed. There are definitely some significant items to unpack here. First, we have that major non-cash goodwill impairment charge I mentioned earlier, $768 million.
Ouch.
Recorded in Q1 2025. And this specifically relates to the Aramids reporting unit, which is within IndustrialsCo. What's telling here, I think, is that this stems from a fair value assessment made way back during the Dow-DuPont merger.
Really? From back then?
Yeah. In retrospect, that assessment made the unit quite vulnerable to any subsequent declines in financial projections. So for you, the listener, this is basically an accounting recognition that the long-term value or earning potential of this specific unit isn't what was previously expected on the books.
Okay, an accounting adjustment, but a big one.
A very big one. Second, those acquisition, integration, and separation costs. They were notably high. $154 million just for Q2 and $279 million for the first half of 2025. And these are primarily linked, as you'd expect, to the intended electronics separation. These are the direct costs of making this huge transformation happen.
Right, the price of the split.
Exactly. Then there are the persistent challenges related to per- and polyfluoroalkyl substances, PFAS.
Ah, yes, PFAS. That's been around for a while.
It has. To give you some context, these ongoing liabilities stem from historical operations and also previous spin-offs like Chemours and Corteva.
Right.
There's a binding memorandum of understanding, an MOU, from January 2021. In that, DuPont, Chemours, and Corteva agreed to share eligible PFAS costs up to an aggregate of $4 billion.
$4 billion, wow.
Yeah. DuPont's portion of the combined $2 billion cap, which it shares with Corteva, is approximately $1.4 billion.
Yeah.
And as of June 30, 2025, DuPont had paid about $645 million against its share. So they're, chipping away at it.
Okay, so they're making progress on paying that down. That's important. But what's the very latest here, especially in the resolution front? Anything new?
Yes, actually. Very new.
Yeah.
Just days ago, on August 3, 2025.
Really? Okay.
DuPont, Chemours, and Corteva agreed to a proposed judicial consent order with the state of New Jersey. This aims to resolve all outstanding legacy claims in New Jersey, including those related to PFAS.
All of them? That sounds significant.
It is. The aggregate cash payment to New Jersey is $875 million. But that's payable over 25 years.
Ah, over time.
Right. DuPont's share, based on net present value calculations, is approximately $311 million. And they already accrued or set aside $177 million for this as of June 30, 2025.
Okay.
So this is a big, very recent step towards addressing these long-standing issues. It provides some much-needed clarity for the company in a key state.
Definitely sounds like a positive step towards resolution.
It does. And beyond this major New Jersey agreement, DuPont has been systematically addressing a range of other legacy PFAS liabilities. It has significant settlements over the past few years. Major resolutions in Ohio, settlements with various water districts.
I remember the water district one. That was quite large.
It was $1.185 billion total. DuPont paid $400 million in Q3 2023. There was also an Ohio natural resources settlement, a Delaware settlement. These have incurred substantial costs, obviously, but they mark a concerted effort by the company to resolve these historical issues.
Right.
Despite these efforts, though, DuPont is still named in AFFF multi-district litigation. That's aqueous film-forming foam.
AFFF, right, firefighting foam.
Exactly. But DuPont's involvement there is primarily due to what are called fraudulent transfer claims.
Meaning?
Essentially, allegations that assets were improperly transferred to other entities, like Chemours or Corteva during the spinoffs, to avoid existing AFFF liabilities, because DuPont itself never actually made or sold AFFF.
Ah, okay. So it's about the structure of the separations.
Precisely. And there's also an ongoing Dutch lawsuit concerning the Chemours Dordrecht facility emissions over in the Netherlands. So PFAS isn't fully resolved yet.
Still some threads hanging there.
Definitely. Now, beyond the legal landscape, DuPont has also been undergoing significant internal restructuring efforts to support all these changes.
More restructuring.
Yeah, two distinct programs recently. The first is the Transformational Separation-Related Restructuring Program, approved in March 2025. This aims specifically to streamline operations for the spinoff. They've incurred about $49 million in pre-tax charges so far, out of an expected $100 million.
Okay, halfway there.
Roughly. The second is the 2023-2024 restructuring program. That was largely complete by the end of 2024. That incurred $198 million in pre-tax charges for cost reductions, asset write-offs, including about $24 million in inventory write-offs. So these efforts are really about making the remaining company and the spun-off entity more agile and efficient going forward.
Right, setting up for the future.
Exactly. And finally, we just need to briefly consider broader macroeconomic and trade impacts. Tariffs, particularly related to U.S.-China trade, they introduce significant uncertainty and could impact competitiveness. That's always a factor for global companies.
Always hovering.
Yeah. And it's important to note, related to China, that the previously reported SAM antitrust investigation.
Oh, right, the Tyveki investigation.
Yes, into DuPont's Tyveki business in China. Tyveki, that durable protective material, Well, that investigation was suspended on July 22, 2025.
Ah, suspended. Good news for them.
It removes a potential headwind, yes. For context, DuPont's actual Tyveki sales to China were less than 1% of consolidated net sales in 2024.
So, not huge exposure, but still better to have it suspended.
Exactly. Removes an uncertainty.
Okay, so we've covered the ambitious strategic shifts with the spin-off, the financial performance underpinning it, the growth areas, and the substantial legal and restructuring challenges DuPont is actively navigating. It really sounds like a company in constant motion, both externally and internally. A lot going on.
It really is.
So if we connect all this to the bigger picture, how is DuPont's overall financial health looking, and what's the outlook given all these moving parts?
Well, when it comes to liquidity, which is key during transformations like this, DuPont maintains a robust position. They have $2.8 billion in working capital and $1.8 billion in cash and cash equivalents on hand.
That sounds pretty solid.
It is, and they expect their cash generated from operations, plus their ability to access debt capital markets to provide sufficient liquidity moving forward. Crucial for funding the separation and ongoing business.
And the debt situation.
On the debt front, their total debt stood at $7.175 billion at June 30, 2025. Now, in preparation for the intended electronics separation, the new company, Titty Electronics, Inc., plans to establish its own new credit facilities and issue notes, take on its own debt.
Makes sense.
And DuPont itself is considering repaying or repurchasing some of its existing senior notes, depending on market conditions. So they're actively managing their balance sheet structure post-split.
Okay, what about the credit ratings? Have they been affected by all this?
Yes. That's worth noting. Following the May 2024 separation announcement, the credit rating agencies reacted. S&P and Fitch placed DuPont's BBB Plus rating on watch negative. Moody's placed their buy one rating on a negative outlook.
So the agencies are cautious.
Exactly. For you, the listener, this signals that the market is sensitive to the financial implications of this major spinoff, particularly the increased debt load expected for Quantity and the change in DuPont's overall profile.
Right. But they are still paying dividends.
Yes, they are. The board did declare a Q3 2025 dividend of sort of 1 cent per share. That often provides some reassurance to investors about underlying stability.
Okay. And looking ahead, what's their guidance for a full year?
Well, reflecting that strong Q2 performance we talked about, DuPont has actually raised its full year 2025 earnings guidance.
Oh, raised it. Even with all these costs and challenges.
Yes, but, and this is an important but, this updated guidance now incorporates an estimated $20 million negative impact.
Okay.
Or about 0 viewers per share. Net impact from tariffs for the full fiscal year 2025.
So they're baking in the tariff impact now.
Exactly. They've quantified it and included it in the revised higher guidance.
Okay. Well, we've certainly unpacked a lot about DuPont today. From its strategic spin-off to its financial performance and that really complex legal landscape, it's definitely a company in motion undergoing a profound transformation. For you listening, hopefully this deep dive provides a concise yet comprehensive understanding of the forces shaping one of the world's major material science companies right now.
Indeed. Yeah, what really stands out to me is the delicate balance DuPont is striking here. On one hand, driving growth in those key areas like electronics and healthcare. On the other, simultaneously restructuring for a major separation and systematically addressing those long-standing environmental liabilities like PFAS.
Yeah.
It's truly, well, maybe a masterclass in corporate transformation under pressure. A lot to juggle.
Absolutely. So here's a final thought for you to consider as we wrap up. How might DuPont's increased focus on its two core segments, the new ElectronicsCo and the reshaped IndustrialsCo, how might that position it to better innovate and compete in an increasingly specialized global market, especially as it potentially sheds some legacy complexities and liabilities? What new opportunities or maybe even new challenges might emerge for this new DuPont post-spinoff? Something to think about.